Hello, gentlemen, and welcome to another Paloview Market Research video. Today, we're going to be discussing real assets, illiquidity premiums, and compounding returns. Because just a few days ago, I put out this video titled My Favorite Assets in the World, where I break down 5 liquid assets that are my favorite in the world today. And it was technically 4 days ago, but it still is my favorite as of today, which is whatever date it is. Now, if you haven't seen that video, please watch it before watching this one, because in that video, as a part of that thesis for 2 out of the 5 assets I discuss, I use this slide to, back up my case, if you will. And these 3 points in particular are very, very important. Okay, so we're talking about, again, real assets, premium for illiquidity, and compounding returns. That is the focus of this video. But this is a slide that was used by Brookfield Asset Management, one of my favorite, firms to track and read quarterly reports on, because I just find that what they're doing is not only replicatable, it is, but they're also a leader in the space. And I think that they're just an underappreciated, somewhat contrarian and traditional at the same time asset manager in the world today. So, a few facts. Institutional funds need real asset to augment returns. Pools of capital are heading to exceed $80 trillion for that institutional fund sector, whatever you want to call it. We want to prioritize, we being Brookfield, being long-term and capitalizing on the substantial premium for illiquidity. So we're going to talk about what that means. Opportunity often lies where the sheep are not going, so we have to be brave, and if the sheep are running away, right? We want to run towards where the sheep are going, because that's where the dragon is. And what does the dragon have? The dragon has all the gold. Now, lastly, and this is the most important point, we're going to walk through a very specific example about how to harness the nature of compounding with real assets, and that building wealth is most reliable through investing in compound returns. All right, now, what is a real asset in the first place? Well, a real asset is something that's considered intrinsically valuable due to its physical properties. So you probably understand that this is real estate, infrastructure, commodities, and maybe you less understand that this includes natural resources and like large scale equipment as well. So you could actually argue that like these GPUs and these data centers, right, that fiber optic cables, this is also included as a real asset. So, unlike assets like stocks and bonds, real assets provide real ownership, right? If I buy a bond, I'm really just getting an IOU kind of letter thing that's just, right? But when you buy a piece of land that has an oil pipeline running across multiple continents, right? You're dealing with something entirely different with much more inherent utility. You have buyers of last resort, something I love to talk about here. If our society is falling apart, right, then what is the last thing to be purchased? Well, people are going to continue to buy food, energy, the basics of, and obviously housing, shelter, right? So you want to think about the things that are going to be paid for with the highest probability, even when things go to shit. That's why I kind of shit on collectibles a lot of the time, because collectible, like when you're investing for bad times. And when you're in buying watches and things like that in good times, thinking it's going to go up in value, it may, but it only goes up in value during periods of good times. So when you're in bad times and you need to sell that watch, you lose money on that watch. And when you are in good times and you can make money on that watch, you end up just buying another watch. So why do institutional funds need real assets? Well, if you don't know, an institutional fund is like a pension fund, a mutual fund, insurance companies, endowments, sovereign wealth funds. Blackstone, BlackRock, State Street, these are all examples of institutional funds. And they are required, obviously, to have a diversified portfolio. So it doesn't really even matter what splits on the pie chart they have. They're going to have somewhere between 10 to 30, maybe even up towards 40% of their entire portfolio allocation dedicated to real assets. Why? Well, they need hedges on inflation, especially now. and they need stable income. They need cash flow. Cash is king. Cash flow is more king. Now, why is this all important? Well, the institutional capital management space is growing exponentially. In 2008, before, the financial crisis, it was 23 trillion, and now we're trending towards 80 trillion next year. This is a big deal, especially when it comes to organizations like Brookfield Asset Management that are extremely skilled at doing the things that we're discussing next. The premium for illiquidity, harnessing those opportunities while also harnessing the power of compounding returns. Now, what is the premium for illiquidity? The premium for illiquidity refers to the additional return investors expect to earn for holding assets that are not easily traded or converted into cash. Real assets like real estate or infrastructure assets are typically considered illiquid, meaning they cannot be quickly sold at market value. So when I buy Bitcoin and it goes up 10% that day, I can sell it pretty much instantaneously unless I have like many billions of dollars worth, right? But if I'm dealing with tens of thousands, hundreds of thousands of dollars of Bitcoin, I can get in and out of these trades fast. But if I have an asset, a real estate asset, and I buy it, it's renting for $1,000 a month. I put some money into it. It's now going, it's now renting for $2,500 a month. I can't, cash out and liquidate that gain in value as instantaneously as I could with liquid assets. So that's why I was specifying that my 5 favorite asset video is discussing liquid assets, not illiquid assets. Most of my personal experience, basically all of it, has to do with illiquidity, dealing with exactly this, okay? Now, investors in these assets often demand a higher return as compensation for the risk of being unable to sell these assets quickly. That makes sense, right? You're taking more risk because you're taking an illiquidity risk, right? So this premium can result in higher long-term results for or returns for those willing to accept the drawbacks of illiquidity. And it's important to mention that with the assets that, say, Brookfield Asset Management deals with, like a oil pipeline, there are just not that many buyers for it, right? So if you buy something for $2 billion and you know that there's probably only like 12 to 24 other organizations in the world who can afford to buy an asset like that and have allocations to do so, you're taking risk. Now, this is a nice chart showing how compounding annual returns relate to illiquidity. So as you can see, venture capital is the least liquid. That's why IPOs are so important for venture capital, because what is an IPO? It's just a liquidity event. It's them selling their asset that they've been developing behind the scenes to the public. And a lot of times that's a good thing, and a lot of times it's kind of a scammy bullshit thing. Private equity is very similar, hedge funds very similar, and then obviously global government bonds, deposit, U.S. fixed income. Those are more liquid, and therefore their potential compounding annual returns are less. So let's talk about compounding returns from real assets. Okay, now these cash flows are most relevant to our discussion because they create higher quality leverage. So as you can see with this very simple chart on the right, 1% improvement per year quickly becomes, because 1% becomes 2%, 2% becomes 3%, 3% becomes 5%. Like if you don't understand exponential charts, maybe I should make a video on that, or you should go learn about it elsewhere because there's probably many other videos about that. But the key thing to understand is cash flows create high leverage opportunities so that you can then speed up your compounding rate of return. Now, let's walk through an example. Let's say Brookfield Asset Management acquires a toll road for $1.6 billion, and that generates them $100 million annually in cash flow. They then can use that asset as collateral to borrow $500 million at a 4% interest rate, say. And with a high quality, stable asset like a toll road, lenders are often willing to provide loans to organizations like this with an LTV, loan to value ratio, ranging from 50% to 75%. Meaning, if I have a toll road and they're like, hey, this thing's going to generate $100 million annually for 50 years. It's not that much. If we, you are wanting to leverage 50% of the value of that, whatever, we're willing to do that at an interest rate, right? This is this is the beauty of what Brookfield does. So they then use this $500 million that they get for the bank to acquire another asset. And they say that asset's expected to do a 7% return. That adds an additional $35 million in annual cash flow to their overall business. So now we're in this hypothetical situation. They have two assets now. So they paid $20 million in interest, but now they added it in net 15% to 150 million, right? So this increase in annual cash flow by 15%, they can then use to, put up more equity to get more collateral to secure more debt and then acquire more assets, repeating this cycle over and over again. So they can take that 115, or they can take that $500 million asset that they just bought, that increase their cash flow to $35 million, but by $35 million, and then they can collateralize it again and buy another one, and then just keep improving their cash flow by 10 to 15% by leveraging these very safe cash flowing assets. I hope that was clear. If you guys have any questions, please comment on this video, because understanding these concepts is incredibly important. Incredibly important, because this is basically math, right? This is just math, and applying basic math to investing on assets that are predictable, that are safe, that are real, is the key to creating what? Generational wealth. And, there's a big difference between being rich and being wealthy, guys. Huge. If you don't know the difference, let's learn together. All right. That is today's video, gentlemen. Thank you for listening. If you have any other topics like this, education-based topics like this, please let me know. And if this was useful to you, consider liking, sharing, subscribing. You are who I do this for every day. Bye, guys.